Well, welcome everyone. It's now 1:30. I'm delighted to be introducing this session today. My name's Andy Critchlow. I'm head of news in EMEA for S&P Global Platts. The session that we're going to discuss this afternoon is the outlook for the oil and gas industry post-COVID, facing a digital and geopolitical set of upheavals. Of course, everyone who has observed and been involved in the oil and gas industry over the last year, 2020, will have witnessed a pretty unprecedented period. This is the third price collapse that we've had in 12 years. We started the year with geopolitical uncertainty, mostly centered around supply in the Persian Gulf. We had what looked like a price war between some of the major OPEC producers, Saudi Arabia and Russia. That obviously led to a collapse in prices because of the timing with the onset of the COVID-19 pandemic. And then in the background, we've had a lot of major changes that have accelerated this year, from the decarbonization of economies and the pace behind that, whether that is policy drivers, whether it's corporates, whether it's finance, a push by oil and gas producers to become more efficient, obviously with a low price environment, that need to be prudent with balance sheets, to look very closely at CapEx and how to be more efficient. That's opened up a lot of windows for more digitization in the industry and a closer look at operations. So there's a lot going on there, and I want to jump straight in. If I can ask all the speakers on the line today to just introduce yourselves before you give the answer to the first question, that would be great. With all these disruptions that I outlined in that preamble, it's not really an option for industry players to kind of wait and see at the moment. How well placed is the oil and gas industry to accelerate its transformation in the post-COVID era as we come out of this? Morgan, if I can go to you first.
Okay, yeah. So Morgan Eldred, MD of Digital Energy. So I think the way I would phrase this is, I would think of it as 2x2, metric. On one side, you have your independents, and on the other side, you've got your IOCs and the NOCs. And then at the other parallel of that, I would have digitalization and renewables there. And we can obviously clearly see that the independents are going to be very much focused on terms of like cash flow at this moment. So how can they really kind of maximize the cash flow that they have, get as much as they can, and are more in that survival mode. Whereas the IOCs, of course, they're going to be looking, what I think post-COVID will have taught them is that, digitalization doesn't necessarily have to be fancy rooms and space-like technology. Simple things like mobility, like Zoom, have created some aspects. I think this industry, though, is still very, very, it lacks behind, and that because it's still very risk adverse. So of course, the independents will be are going to be less risk adverse, but this is an industry that still has struggled on the digitalization aspect because of the risk nature. And I still think, it's more about building mitigation strategies and the opportunities that come from that in terms of the way forward. If we look at it, I don't necessarily see a big bang in terms of digitalization. I see more pragmatic steps to, as we've seen, video conferencing, people working from home, it's going to be these more smaller steps that will play it. But of course, it's going to be two different stages, right? It is going to be the independents versus the larger players with a different risk appetite. And then it's going to be the focus on, digitalization or renewables. The big players, their shareholders are going to want them to be involved, with the crazy multiples that are starting to be out there. They're going to want them to have, access to non-hydrocarbon energy sources.
Vladimir, if I can go to you on that, obviously, representing OMV, major refiner, and how's this affecting, your outlook in that sense?
Yeah. Hi. Thank you, Andy. So my name is Vladimir Langhamer. I'm the managing director of supply and trading OMV, which is the trading arm of OMV's thing in London. And to your question, I think there are multiple kind of pathways to do that. And to be honest, I always describe oil and gas industry as being a heavy industry. But for that, I think it has gone through a multiple cycles, somebody could call it crisis, but where it actually reinvented itself. And I also believe, all this kind of energy transition will be incredibly capital intensive, and it's going to be not large project, but sizable projects. And I think with that, actually, the oil and gas industry has some experience. So in a sense, the gas and oil industry is more experienced with turning around fundamental fundamentals of economies in the respective countries, rather than the Googles and the Amazon of this world. And I would agree with Morgan that the digitalization is certainly a part of it. Maybe it's not as fast as maybe some people would think, but I also think one of the reasons is because we are very focused on health and safety. This is an investment that when you just decide, you can't change kind of two years down the road. So I think it's more, it's not risk averse, but within the context of this being a much, kind of longevity, you need to make sure that what you choose is something you can actually live with, for many years, and you can scale up. Certainly there could be done, it could be done much more, and I'll see that the industry doing much more. I think there are, startups, there are commodity tech companies that are trying to push into that and make the whole processes much more efficient, much more standardized. You could see it with VACT and the whole North Sea trading kind of being on a platform, which enables a much more efficient, middle office, back office settlements, kind of post trades. The whole industry obviously gone into the bandwagon of data and data analysis in trading, which is something which kind of took off, I would say 2-3 years ago, and it's much more developed. I mean, there's so many data available now. You have the Keplers and the Vortex is kind of delivering you data that were proprietary 3-5 years ago and actually visible to the market at the moment. So I think the industry actually, in my view, has a competitive advantage of having the experience with large projects, having the experience of turning around fundamentals of economies, and doing it in a very safe and stable way.
Just a comeback on that, the industry has a lot of data, and certainly in the trading space, the large trading houses, but also the IOCs, in their trading divisions, they have decades and decades of data, looking at how trading is affected by supply-demand fundamentals. Is the issue more than how the data is interpreted and the sophistication that's applied to that?
No, I don't think it is. It is, but you might have a long kind of long period of data, but the data is not really very granular. It's the problem. Why don't you have really algorithmic trading in commodities, but you have it in equities? I mean, you have, I don't know, I'm not an equity guy, but probably hundreds of thousands and millions of buys and sells every day in an equity, which is something that then an algorithm can work much more better than when you have one price of oil, dated per day. So you have 40 years, yes, but actually we're not, I wouldn't call it a big data, because you don't have the frequency that you need, and because you don't have the frequency on a relative short period, also the influences change. So you still need people to interpret this. It can't be digitalized to the point where you have kind of algorithms telling you kind of what the future will be. I mean, exaggerated. I think you can have algorithms telling you, there's something different than it used to be, and a man or interpreting what it means and how to profit from it on the trading side.
Thanks, Vladimir. James, if I can come to you, we've gone a long way, obviously, in that journey. Where do you see the industry going this year as it comes out of COVID? What do you see the opportunities? Do you see it accelerating a drive towards more efficiency and greater digitization?
Okay, so I'm James McCallum, Executive Chairman of Xergy and Professor of Energy at Strathclyde University. A couple of responses to that, Andy. Your introduction sort of positioned us as, you know, we've gone through 3 cycle downturns in the last 12 years. If you're a little bit older, you can go back further than that, right back to perhaps the last really big downturn in 1986, and remember how that was, where the industry followed a pattern of downsizing and then ultimately transitioning into a very different industry as it pushed into the offshore environments, deep water environments, et cetera, et cetera. This time, however, feels very, very different, Andy. You know, it feels very different because the reality is it depends very much on where you're sitting. This is the European section of the conference, and so I think I'll focus in on that. Morgan touched on perhaps it feels differently if you're sitting in the seat of an independent or an IOC. I think maybe we'll get back onto that in a second. I think it's very much more about whether you're a low-cost producer or you're an international oil company that's used to operating in conventionals and in the conventional space. If you're sitting in Europe right now, change is not only compelling, it's an issue of survival. The issue between the independents and the IOCs, as we know, are going through an agenda of trying to understand what it is to be a diversified energy provider. You know, whether that's hydrogen, whether it's renewables, whether it's actually staying where you are, but diversifying your gas portfolio. If you're an independent, it's all about being the low-cost producer in that space. And my friend Walter Simpson in the Middle East section, I think, put that really beautifully when he sort of like said, you know, it's all about using digitalization to understand what it is to be the best-in-class low-cost producer, minimizing the cost of your production, minimizing your emissions in the ESG space, and maximizing your business efficiency, and developing your staff. Now, for me, I think that is the real space where we will see change happening in the next year, but it will be driven by necessity. If you're sitting in the Middle East, for instance, and we heard from Sarah Akbar, you know, there's not an awful lot of spend going into the digitalization space right now. That can be because of cash constraints in terms of cash flow in the Middle East from your production. But the reality is, if you are already the low-cost producer on the world stage, then there is not the compelling drive to have to change. In Europe, there will be an essential need to change to survive.
I'm going to take that point. I want to go to you next, Yana, because, you know, I think looking at the industry in Europe, you know, increasingly, I think, well, kind of what's in it for international oil companies still being based in Europe? You look at the UK, 20% of the FTSE 100 is still weighted towards resource companies. You know, Shell, BP, you know, are amongst the top 5 largest companies on the FTSE 100. You know, it's still a major market for raising capital for the oil and gas industry. However, and this is reflected across Europe, the policy of policymakers, of governments, is profoundly shifting away from hydrocarbons and making it harder for them to do business. So kind of, what are the risks that come from that? And you know, if you're in the boardroom of a Shell, a BP, a larger IOC in Europe at the moment, how is this really affecting your decision when across the table at a government level, policymakers are, from, you know, what you can see, making it harder to operate?
Yes, thank you, Andy. So Yana Popkostova from the European Center for Energy and Geopolitical Analysis. So you examined and explained the situation very well. And I think what we observe in the EU and actually beyond European borders as well is that the decision-making within the boardrooms is very much impacted by the very strong signal that Europe gave with the Green Deal, but even before the Green Deal. And this is going to impact not only strategies of European majors, but also really diversification strategies and portfolio reallocation of companies that are not within the EU, but are going to be impacted by this really continuous momentum to greening, to green stimulus packaging, to more really climate respective investment. Directly to the question that you posed at the beginning of the discussion, I think that the oil and gas industry at large will transform, but this transformation, especially in the months ahead, will be very much in the context of the continuous trials and tribulations of the COVID saga. And I think a few issues are really critical for us, and they would kind of steer the direction of travel for the oil and gas industry in the year ahead, and you'd very much kind of inform the transformation of the sector holistically, not only of the IOCs, but also of national oil companies and the strategies of oil producing nations. And I think you started very well explaining the demand and supply crisis that we observed in 2020. But I think that the collapse that we observed would see only a very anemic recovery this year, despite the rollout of vaccines, the cascading lockdowns and restrictions. The pace of recovery remains very uncertain. And this would fit really directly within the transformation strategies of oil and gas companies. A new highly contagious COVID variant is present in the EU. Health officials and policymakers, at least here in Paris where I stay, are warning of a third wave and of new cascading lockdowns and draconian measures to actually stop the increase of the infection rate. So the return to pre-pandemic economic activity anywhere outside of China would be very difficult, not within sight in the months ahead. At the same time, I think supply is something that we have to examine, and it's going into this oil demand supply balance that we're going to look for, and this balance will be important to actually to transform and to fit into the transformation strategies of oil companies. I think a very huge feat for 2020 was the OPEC Plus alliance, and despite of the price war last year in March that ended up in the negative territory of WTA, as you said, or some compliance issues over the summer, notably by United Arab Emirates and Iraq, I think OPEC really kind of demonstrated its continuous importance and force within the market. And I think OPEC will be very decisive actor going forward, but also an actor that is going to impose repositioning of the different oil companies within the member countries to actually transform, accelerate this transformation and continue to thrive in a new severely carbon constrained future. Now, how the cartel continues to ensure discipline amidst today record inventory levels and spare capacity will be decisive for the delicate balance going forward, but also for those strategies evolving as we continue down the path to 2021. A critical issue that we also touched upon is the cascading climate commitments. Now it's not only the EU, and this is why I think the issue is much bigger than the EU and has to be really discussed on a global level. We have climate commitments by the major economies across the world. The US is coming back to the table now with the new administration. And I think the Greece stimulus spending attached to these cascading climate commitments is going to accelerate the shift to clean energy technologies, renew the carbon pricing momentum that is critical for the oil industry, and depress further the hydrocarbon demand, then putting pressure on the break-even levels and accelerating even further this push to decarbonize. And I think this is also something that is going to influence the strategies of the companies, and the intensified regulatory action that we saw, but also the technology innovation in terms of clean energy solutions is going to weigh on the industry, but also can be used by the industry as an opportunity to actually intensify in this industrial innovation. We speak a lot about hydrogen, we speak a lot about carbon capture, utilization and storage, but also harnessing the new innovation in terms of reducing the carbon footprint of hydrocarbon production and a kind of anchoring the industry again in the new era of clean energy innovation. And since I'm a political scientist, I think it's important for us to also mention that the COVID-19 pandemic hit the world in times of tense geopolitical geopolitical environment and hyper-realist maneuvering in strategic parts of the world, from the South China Sea to the Eastern Mediterranean, the Strait of Hormuz, the Sahel area, the MENA region itself. And I think the pandemic only accelerated, on steroids, as I often say, shifts and existential questions within the industry that were there prior to when we added COVID to our vocabulary. And I think those existent trends were really kind of pushing the industry towards this acceleration of strategies, portfolio allocation, and thinking about how they can become an actor in this new shift to a brave, new, clean energy future. And I truly believe that the industry would continue to be a key actor in the years to come. So the outlook for the oil and gas within the EU, but also globally, would depend on the capacity of the industry today to pivot quicker than planned, but it was already planned, to this new form of agility in order to navigate the confluence of crisis. And I advocate for this kind of 4D approach that was used in the EU to kind of really describe the European transition going forward, and I think can be very well applied to the transformation of the oil and gas sector. And this would be the decarbonization, diversification, digitalization, but also democratization in terms of letting the public know Yana, a little bit more what the industry is doing.
If I could just pause you there, I think it definitely, I get the sense from that this is going to act as a kind of major stimulus and incentive for oil and gas producers and the whole industry to expedite any changes that were going on ahead. And I think it brings us quite nicely to the next question point, which is around this demand issue. Now, there was elements of what you said there, Yana, which were quite kind of skeptical about where we go with demand. Of course, the IEA's latest projections have global demand adding 5.8 million barrels this year per day. But that's still significantly below 300,000 barrels a day below where we were at the pre-COVID level. And I'm kind of going to put this question to everyone. And if I start with you, Morgan, I mean, do you think that we've peaked? Do you think 102, 105 million barrels a day crude, that is the kind of that's the top of the market now? There's obviously a lot of debate at the moment amongst players in the industry about where we are on peak oil. Do you think we've reached that point, or do you think that population growth, economic growth, stimulus, some people talk about a super cycle already in motion in commodities, that is going to be enough to lift demand out of the doldrums?
Well, I mean, this is an industry that's very cyclical, so I'm not going to go and say that I think we've peaked, right? I think there definitely is a transition that is occurring, right? I mean, if we look at, like, in the US, 67% of their energy is rejected. So there's all kinds of, there's all kinds of loss. If we're looking specifically at hydrocarbons, we still need to, electric vehicles, there's still more people, there's still going to be, faster technologies. We still can't model the impact that gadgets, right, have on the energy usage. So I don't want to necessarily say that. What I do think is really being clear in terms of demand and supply is that, and we're seeing this with our companies that we work with, our clients, is a shift in the supply chain, right? So this is where we're seeing a lot of digital, I'm going to point digital technologies, but a lot of AI to predict, the demand and supply of hydrocarbons, the demand and supply of materials. We've seen that certain trading routes have actually, the cost has gone higher. And so
I guess Morgan, I'm going to come back to you there though. Is the computer better than the human at figuring out this key problem of supply demand?
Well, if you speak to me and my company and the successes we've recently had, I would say absolutely, right? I mean, so we've recently been able to, for which one of our clients won a global award. We cut 30% of fuel out of the system, right? So that also includes, the asset utilization that goes on that, where we're also now looking at predicting stock levels, right? And if I can, predicting stock levels, if I can remove 25%, of my stock and realize that into cash, that's now cash that I have in a time now where I really, probably need that cash flow. So, I think absolutely, when it comes to supply chain optimization, or let's call it supply network, because it's more of a network than a real change, this is where the computer absolutely is is out building demand, because this is not crazy algorithms that need to be done, right? This is very precise algorithms that can be done. Yes, there's lots of complexities that go, but there's certain inputs and certain outputs that can be done. You have certain amount of materials that are required within your operations. You have certain amount of deals and production that you do that go to your clients. So you can actually start to model this and break it down, almost at micro scale things, see the impact and go forward.
So James, if I can come to you on that point, I mean, 20 years ago when I was a reporter covering energy in Dubai, my editors were still getting me to drive over to the East Coast and look at how many tankers were parked outside Fujairah to get an idea of what was happening in terms of supply demand around the world. Do you think that there's still a role for that, actually getting out and just physically seeing what's going on? And I guess part of that as well is, where do you see demand going from here? Obviously, we're going to eventually get back to pre-COVID levels of demand, but do you see it going further than that? Do you see have we reached peak oil, or have we still got a way to go?
Okay, so taking that one right on the head, you said we're obviously going to get back to pre-COVID levels. There are some people who would say to you, well, we're not obviously going to get back to pre-COVID levels. I'm not one of them, Andy. I actually do think we'll get back to pre-COVID levels, and I think we will see, continued growth in demand. But the demand and the use of hydrocarbon product will go into different areas. Clearly, we are seeing an enormous transition in the electric vehicle space, but in terms of the growth of just simply the middle classes across the world and their demand for more and more product, we will see fossil fuels being used in a very, very different way going forward, and I think that will translate into a growth in demand. So I think picking up on the point which Morgan just made, where we can see digitalization coming into the companies in an area where it helps them with their existing processes and improves their existing processes, we'll see the uptake of that. Because of course, the industry now is a fraction of the size that it was prior to the downturn. The COVID demand supply issue is a secondary issue to the recession that we've been living through for 7 or 8 years, which has eroded enormously the talent pool that exists within the industry. And as we come out of the COVID demand supply crisis and the industry does go back to activities, we're going to have to embrace digitalization to enable us to do just simply what we did before. And we're going to have to embrace technology and process efficiency improvement to actually enable us to actually do it at a lower cost point.
And of course, when you've got over $500 billion of capex that suddenly disappeared from budget, there's got to be some efficiency that comes somewhere, right? Vladimir, if I can go to you, and I just want to drill a little bit deeper into this subject as well, and kind of look at some of the demand issues in Europe maybe that arise from this, and you have seen this shift in mass shift in human activity, and so people aren't flying, for example. How are you seeing this play out now in the aviation market in Europe, aviation fuel? I mean, there just isn't any demand. I mean, where is that going? How is from the downstream perspective, how do you manage that? And then on the other side, coming into 2020, everyone had a view of what IMO 2020 would do to fuel oil. How has this affected that as well? And do you see a return to that process picking up after 2021 and so forth? And then on the transport fuel side, some of the EU regulation now that's coming in to change passenger transport, how's that affecting the diesel market? How's that affecting gasoline in Europe?
Okay, I think there was 3 questions in there.
Yeah.
I'll try to go over all of them. I think, look, I maybe start with the last one as a leading. The downstream industry in Europe has been under a pressure because the demand, certainly in Western Europe, has been declining actually, over, I would say, last 10 years. I mean, 10 years ago, you would still could burn, fuel oil for power generation, which was a large part of what was produced. Then obviously that was banned or phased out. That's not possible anymore. The industry has actually been able to transform that hydrocarbons into high value, be it diesel, be it jet. So I think COVID, in a sense, just accelerated this. So it wasn't a surprise. And I think, a lot of people have been prepared in a sense, or at least knew the way to do that. Obviously, COVID would accelerate all this, but it would be in conjunction with the technology and digitalization. So again, I think the industry, people think about oil and industry of the dinosaur, and it is slow moving, but because of the size, it's not obsolete. And I think it will be able to figure it out. If I go to the question of jet, and again, it's a good example. I mean, almost overnight, you had one of, something that constitutes something between 25 to 30 million barrels a day, demand, basically go to zero, not entirely, but to go to 10 to 15 million. Almost overnight. And I mean, is there a jet, flowing out of all the tanks? It isn't. The industry, even within months, has been able to contain this issue. Yes, less production of jet. You had the processes being adjusted, so you don't produce as much jet. You blend more jet into diesel, into the diesel pool, which you usually do in winter anyway. And you try, it goes to marine fuels, to touch on the IMO. So I think there are very talented people within that industry that have learned over the last decade to be much more quicker in decision making and much more, risk taking in sense in sense of, okay, we'll try this. If it doesn't entirely work, then we need to have a plan B from the onset. And I think, I believe, my personal belief is once there is a vaccination program, and in large parts of the population will be vaccinated, there will be again flying, because people would want to travel. I think there is a pent-up demand for traveling. I mean, you could see it even in Asia or in China, where the domestic travel has actually picked up to pre-COVID levels. Yeah, so I'm not so pessimistic in a sense on the demand. I think people will want to kind of come to a similar style of life as before. But in certain parts it will transform. I think the transformation in Europe is mainly to go from fuel, so transport fuel, to petrochemicals and chemicals and high level. I mean, with it's not just about plastics. It's really about advanced applications of those things. And that goes up to the point where this industry, of course, is looking, because it's in kind of involved in plastics, on circular economy, which is one of the plastics are a kind of prime example of that. So I think there will be an acceleration. It will be helped by technology where it can, and there's so many things where the technology can help, and is better than a man. I absolutely agree. And I think we need to embrace more also the technological thinking in the oil and gas industry, in the thinking of some of the technology giants adapted to the oil. I mean, even Amazon's gonna move fast and break things. Okay, we don't want to break things because it usually has a big impact, but you will need to try to be more risk averse and have more scenarios how to move forward. And to get the transformation, but I don't see the peak oil anytime soon.
I mean, Vladimir, if I could just have a follow-up on that last point. It's very interesting. Do you think that the industry needs a disruptor? The oil and gas industry, okay, you can make the argument shale was disruptive and still is disruptive for certain parts of the oil and gas industry, but actually, there isn't a Google or an Amazon in the industry that has really challenged the established model of IOCs, which has been around for 100 years.
Yet.
No.
Yeah, I think that's the answer, right? I mean, if there is an opportunity, and I still think there are investors out there that are looking into this industry, because I mean, I like renewables. I do recycle everything I can. But if you look from it economically, the returns for investors from those parts of the industry are still not where private equity or even some of the funds would want to make the money, because their expectations from their clients is higher. So I think, again, the oil industry is delivering, okay, maybe not 2020, but I think has a potential to deliver the returns. But you're right, if there is technology that is a disruptor, everybody will jump on it, because the leverage, it's incredible. I mean, energy is the backbone of each of the economy, and it will stay like that. Yeah, and if there is a disruption, a technology for how to produce that, or how to manage that, how to transmit that, then I'm sure there will be a disruptor, and maybe that would not be a bad thing.
It's interesting because there isn't really a bulk sales model like Amazon has. You subscribe to Amazon Prime, you get your TV, you get your packages, you get a whole bunch of services with that subscription. You can't go to an IOC and buy your fuel, buy your electricity, buy your your coffee in advance, on a prepayment kind of thing. Maybe in the future we'll see that, and if we did, I guess filtering down to the downstream, to the trading element of this story, that has a really profound effect, because it could change the behavior of tens of millions of people. Yana, I'm going to come to you now, because you were skeptical about this idea that we do have something beyond 102 million barrels a day approximately to go in terms of demand. I mean, why is that? Why do you think we may have kind of reached peak oil?
I never said that I think we've reached peak oil. So I'm skeptical that the demand would go to pre-pandemic level this year. Then in the long term, I would not argue for that. I do believe, and this would really second a lot of the what was said already by James, by Vladimir, but I think that globally demand probably would go to pre-existing levels because of something that you mentioned, demographic growth, then the access to energy, that it's one of the key goals that the international community is really pushing forward. And this access to energy might be done through renewable energy. And there is a lot of innovation in centralized renewable energy generation, so on and so forth. But there would still be a lot of demand for a traditional hydrocarbon energy. Peak oil, I think it would come before the 2050, maybe 2030 something. So I don't think it would be this decade. And
let's just be specific here. So if we sort of narrow it down to sort of something in the 2030s, what would be the number you would put on peak oil?
What would be the year I put on?
What would be the number? What would be the number in terms of barrels, net barrels, demand?
92.
I think we might be below where we are, but that's a bleak outlook.
I think I didn't understand the question.
So maybe. Where would you put? So if we were if pre-COVID levels we were around 102 million barrels a day, where would you put the peak in terms of net barrels? Do you see it going at 100 to 110?
Oh, okay.
Yeah.
Sorry, I didn't understand.
No problem.
I think maybe by the mid 30s we will have an escalating demand by 107, maybe 110. But I don't think actually the demand would go to really escalating much more than this, just because the technology is rapidly innovating. I really believe that the renewable energy technology would be scaled even more rapidly this year, but also in the next decade, because of the commitments all across the globe.
Yeah, that's quite a conservative estimate in that sense. It's you don't really see a world going above 110 million barrels a day. I think that's interesting, and it brings us back to our kind of third topic of discussion, which is around capex. It's around how the pressure to return cash flow for operators, how that plays into this story now. And I'm going to kind of come to you, Vladimir, on this one. I mean, it must be difficult to make an investment case for a refinery in Europe at the moment.
I think it's impossible.
I mean, can you kind of elaborate on that? Do you think there won't be any more refineries in Europe?
Yeah, but certainly for a refinery. But to be honest, if you looked at some of the kind of debt markets in 2020, they were still very generous, and some of the deals that have been done to finance oil and gas, have been at very low levels, potentially, unprecedentedly low levels because of the amount of kind of free cash which needs to be allocated somewhere. And also I think that the oil industry has now into the mode where, any investment that doesn't pay for itself in 5 years, we just don't do because we don't know. And that's, it's a change, but you can still do that. Yeah. As it's with renewable technology, I mean, the technology for oil and gas is getting cheaper. People are finding smart ways of reusing it or using it longer, or using it much more, focused because of the pressure on the capex. I always use the paradox. I mean, oil has been pre-COVID at levels of $35-40 a barrel, producing more barrels than it was at 100. So obviously, the economy has had to really push that even at those levels. So I think a lot of the slack has been cut. As I said, a lot of technology. I mean, I'm not an upstream guy, but some of the technology I hear, on upstream or be it conventional, non-conventional usage of data and 3D modeling to really decide of where to drill. I mean, it's mind-blowing. It really does merge into the world of the Amazons and Googles with large data and large simulations.
Absolutely.
Yes. I mean, James, if I can come to you on that as well. I mean, as a Scotsman, the North Sea, the actual first well was the loan for that was underwritten by the British government as a kind of stimulus to get that industry going. I don't see the British government giving soft loans to any oil and gas operator to sink wells in the North Sea anymore, and it's difficult to see where operators go. If you look at the funds, the pension funds don't want to invest anymore. The banks are reticent about lending anymore. How does the industry finance itself? I mean, if it can't go to these three avenues, does it go and do crowdfunding?
Look, I think you're absolutely right. In fact, I think it's the contrary. I think we will see the introduction of carbon tax as well, just to make it even less economical going forward, particularly in areas like the North Sea. And the North Sea, as I said at the beginning here, is facing a very survival issue. The reality here is it will the investors will follow the low-cost producer, and the low-cost producer will be the most efficient and effective producer. And a big part of that will come down to how one accesses the talent and accesses the knowledge to actually make that your business processes work effectively. And you asked the question around, we don't have a Google Energy or an Amazon Energy in the industry. And I said, yet. I mean, the reality is one of the largest challenges we will face going forward is to attract the generation of data scientists, data engineers, young people into an industry. Through the 80s and 90s, we failed to engage new generations of talent. We failed to tell our story, and we're paying the price for that right now. And the Googles and the Amazons come with a ready-made audience who listen to them, who see them as having a climate agenda against an industry like ourselves, where they see we do not yet have a believable climate agenda. And all of this is in the mix. But at the core of that will be the digitalization products that enable our existing companies to go forward highly efficiently. Mark Moody-Stewart said in his earlier session, sadly, many of the players that we know and love just simply won't come out of this cycle.
Hi, everyone. Just a 2-minute warning for the end of the session. Just a 2-minute warning.
Great, thanks, Brian. What would be your view on that, Morgan? Do you think that there's going to be, some of the titans of the industry, there's cracks starting to appear?
Yeah, absolutely. I mean, you are right. And I mean, the whole green initiative can't be under, that's a mega trend that can't go. And maybe just to add on to what James said there, the industry is such, my team of data scientists, their internal cost has gone up 10%. So, if you even look at that, it's like, you've got these traditional industries that you're going for. These new industries, they're made for this environment, right? So there will have to be new operating memorandums. if you even look at Scotland, you can see massive investment now in terms of, the transmission lines to support these new offshore, wind. So you are seeing significant investment shifts. So I do believe that it's good. I think one of the things will also be, how can you integrate things more? As an example, why would you shut down a well that's got a 70% water cut when potentially you could look at scale and at things? Could I turn that 70% water into not necessarily potable water? Could I get that into a water that I could use within other industries that need to do cycling or things?
Which is what they've done very effectively in Oman for many years, where they've had a historic high water cut, I think above 50, 60%. And, they've done a lot of innovative initiatives to reuse that in some way.
So, yeah, so I think it's going to be more about smart energy usage, in terms of being high performers, and looking at it as, an energy company, not a pure hydrocarbon player.
So just to finish up, we had our 2-minute warning there. Thanks everyone for the participation today. I've really found this a really engaging conversation. We didn't unfortunately get through all the questions, but I think that we've touched on all the issues, which is the important thing. Just to wrap up, 2 words, you get 2 words, one for the opportunities that are going to come out of 2021 and one for the risks. What are the dangers? So James, we're going to start with you. Risk and opportunity 2021.
Risk, like no collaboration, opportunity, knowledge liberalization.
That's not what, that was more than 2 words, but I'll let you get away with it. Morgan.
The opportunity is, I would put vision. So new visions can be crafted, and the risk is free cash flow, right? That's what's going to be the risk for organizations.
Great. Vladimir.
Yeah, I think, look, I look at it from a trader point of view. The opportunities that COVID has changed flows globally, and the trading industry will have to make the transmission of that. The risk is, yes, I think cash flow in a sense of being able to finance that. But one of the one that James made is the risk of not being able to attract the right talent.
Yana, final say.
I agree with everything said, and just from a geopolitical perspective, I think the biggest risk would be if there is a geopolitical escalation in very strategic parts of the world that would prevent us to actually not only pursue the energy transition, but also pursue the transformation of the oil and gas sector. And the opportunity would be just to use the crisis to leapfrog to a new reality, which is much more efficient and utilizes much more inclusively the talent, as was said by a few of the speakers already.
Very succinctly put, and yeah, I think it's a very important point that we start 2021 in some regards in the same way that we started 2020 on that geopolitical story. That there is a lot of uncertainty around some of these issues to do with the Middle East at the moment. A new administration taking over in the US. What does that mean for the relationship with Iran? What does it mean for the relationship with China? What does it mean for the global push to emerge from this pandemic? And of course, there's a lot of questions around the efficacy of the vaccine and the effectiveness of countries and their policy of rolling it out, and inequalities around the world. So I think that we can all agree that there's going to be lots to write about, lots to talk about, and there's going to be lots of price volatility probably in 2021. Thank you everyone for your time today. I've really enjoyed this.
Thank you, Andy.
Thank you, Andy.
Thank you.